Recently, I was challenged to show someone how to pick good active funds with a crying laughing emoji because this person thinks it is literally impossible to find active managers who can beat their index over 30 years. So naturally, I've decided to accept this challenge, and at the end, you can be the judge of whether it's impossible. In this video, I'm going to show you exactly how it can be done using an example of a fund that has literally beaten its index in every single rolling 30-year period in its history, 110 times in a row, after fees by a massive margin of about 4% per year. Here are 5 reasons this fund has succeeded where most other active managers have failed. And these are the things I would suggest looking for to find a good active manager. By the way, in case you're wondering, I have no incentive of any kind to promote this fund. Reason number 5 why this fund has been so successful: cost. Yes, cost is important. I'm certainly not denying that. For every basis point or 0.01% of extra fees, you've got to generate an extra basis point of return to make up for it. So expenses have a direct impact on the end result. Obviously, this fund is more expensive than most passively managed funds, but compared to active funds, it's one of the least expensive, which essentially gives it a head start against other active managers. You can find it at 0.86% per year on no-load shares in a typical brokerage account, 0.57% through a financial advisor, or as low as 0.47% in your 401k if you're lucky enough to have it as an option there. And many people are. Okay, now for the reasons that you didn't already know about. Reason number 4 that this fund has been so successful is its scale and access. Now let me tell you, these things are especially important for international and small cap funds, where there are a lot more companies that are a lot less well known. At the crux of it, an active manager is trying to invest in the companies that will do better than the index and avoid the ones that are going to do worse. So in order to do that, they need better information, right? But there are over 2,000 companies in this fund's index, the MSCI ACWI ex-USA. Professionals say the MSCI ACWI, but you might read it as MSCI ACWI ex-USA. So here's the question. Can one person in New York really research all those companies? Absolutely not. But this fund has 12 portfolio managers and 100 analysts based all over the world that are splitting up the work, scouring the globe for the best investment opportunities. They also regularly meet with the CEOs and CFOs of the companies they invest in, which many other active managers do not get to do. And certainly individuals like you and I never could. But when you've got billions of dollars to invest in a decades-long relationship with the company, they'll find the time to meet with you. Now, don't worry. They're not allowed to get any inside information, but they can get information that helps them make better investment decisions. I'll give you 2 quick examples. Often, they'll ask how the company plans to spend their money. If the company says, we're going to look for acquisition targets, and the analyst knows they have a terrible track record of buying companies, then that might be a reason to avoid their stock. Another example will be to ask companies about their opinions about their key suppliers in order to get insights about those companies. If 5 industrial companies all say they've been really impressed with the same new automation technology, that automation company might be attractive. The future is never certain, and better information doesn't always lead to better investment decisions, but it has been shown to be an advantage over time. Reason number 3 that this fund has been so successful is its flexibility. Flexibility, along with the number 1 and number 2 drivers of success that I'll mention in just a moment, is important because it leads to greater consistency. That's the number 1 place that active managers fail. Every fund can beat an index in a year. Think about it. Pick any random stock, and there's a 50% chance it'll beat the index that year. Do that 10 years in a row, and there's a good chance you'll beat it at least once. What's hard is doing it consistently, over time, after expenses. That's where flexibility comes in. Markets are cyclical. Sometimes growth stocks are in favor. Sometimes value stocks are in favor. Sometimes tech stocks are doing well. Sometimes energy stocks are doing well. And where a lot of managers fail is they box themselves in to one thing. If you read the descriptions of how they're managed, a lot of funds will say things like, we invest in large cap value companies, or we invest in high quality companies that are in growing industries in the USA, or we invest in high quality companies that are growing industries in developed markets outside the US. The point is they're boxing themselves in. High quality sounds great. But what about when we're coming out of a crisis? Often, low-quality companies that were near bankruptcy are the ones that would do the best in that environment. Now, let me tell you, the market is always changing, and this fund has none of those constraints that would keep it from adapting to those changes. It can buy big companies, small companies, value, growth, developed markets, emerging markets, and over the course of time, its composition has shifted to adapt to the changing market environment. That's the only way you can realistically beat the market in 99% of rolling 10-year periods for nearly 40 years, like this fund has. Otherwise, there's bound to be a period where your style is just so out of favor, it can't keep up. Of course, flexibility doesn't guarantee you'll be right, but it does give you a better chance of being right consistently over time because you can adapt to the changes in the market. Reason number 2 that this fund has been so successful is its long-term approach. Nearly every investment manager will say, we take a long-term approach, but the portfolio managers on this fund are actually paid to do that. Their compensation is driven by their 1, 3, 5, and 8-year track records, with the heaviest emphasis on the 8-year. In most active managers, short-term results like the quarter, the 1 year, or maybe the 3-year are much more heavily represented. Why is a long-term approach an advantage? Well, put simply, because it's easier to predict the long term than the short term, and big long-term changes are more impactful to long-term results. For example, most investors look a maximum of 1 year ahead when making their predictions. That also means they also get caught up in what interest rates are doing, what inflation is doing, and all kinds of other stuff that moves markets in the short term but distracts you from what matters in the long term. Let's say an analyst determines a company is going to become profitable in 18 months. They can't predict the timing exactly, but they can see it's clearly going in that direction. But right now, everyone else is focused on the short term and all the other distractions. They can buy this company now, and then in 6 months or a year, when everyone else sees it's going to become profitable soon, the stock price is going to go up a lot. That's exactly what happened this year with a company called C Limited that this fund holds now. So thinking long-term allows you to focus on the big picture that most other more short-term oriented investors might be missing. You can tell if a fund is taking a long-term approach by looking for their turnover ratio on their website or a place like Morningstar. For a stock fund, a turnover ratio in the 30s or lower is a sign that they're taking a long-term approach. The number one most important reason this fund has been so successful is its unique investment process. This is very rare in the industry, but it's been a key ingredient for its success and consistency over time. There are 2 key aspects to the process. There are multiple portfolio managers that each manage a slice of the portfolio independently, and the analysts also manage money. Here's why those things are so important. There are many ways to be a successful investor, but none of them work all the time. Having multiple portfolio managers with different approaches and different backgrounds does 2 things. First, it allows the fund to stay diversified and allows each portfolio manager to invest in the way they are best at. There's a reason that bands don't have 5 guitar players, and there's a reason that bands don't have one person trying to play the guitar, the drums, and the bass all at the same time. This system allows people to do what they're best at while keeping the overall fund diversified, and that leads to better, more consistent results over time. The other advantage of multiple portfolio managers is that if one retires or leaves for whatever reason, it's maybe just 1/5 or 1/10 of the portfolio that's changing management, not 100% of it if there's only one portfolio manager. It's become a lot more common in the industry to have multiple portfolio managers, but having them all be independent in roughly equal portions like this fund is still pretty rare. Often, it will be something like 3 portfolio managers, but one of them makes all the final decisions. The other component of the process that's so important and unique is that the analysts manage money. This helps in 4 ways. First, it helps this company attract some of the top talent in the industry. Second, it shows true conviction. At most active managers, analysts just recommend stocks for the portfolio managers to buy. But let's say John is super charismatic and Derek is an introvert. More of John's stock picks are going to be chosen because he's better able to convey his excitement, even if Derek's stock picks are actually better. At this company, where the analysts also invest, they can be as enthusiastic as they want, but the portfolio manager is going to say, cool, how much of this do you own? That's a much better way to convey true conviction than by how good of a sales pitch someone can give. The third way it's helpful to have analysts manage money is that they're on the same level as portfolio managers. That's not normal. Usually portfolio managers make significantly more, so every analyst wants to get there. But some analysts are simply great at what they do and can help the fund results the most by staying an analyst. For example, someone might be a great healthcare analyst because they used to be a doctor for 20 years and can understand all the science behind new drugs that are being developed. But would that help them be a good energy or bank investor? Probably not. So this system would allow them to stay an analyst. And the fourth reason it's helpful to have analysts manage money comes back to consistency. Portfolio managers age at the same rate as everyone else, and eventually they retire. There are countless examples of legendary portfolio managers whose funds dropped off a cliff when they retired. In this system, not only are you only replacing a small portion of the fund's management because of the multiple portfolio managers, but the analysts who do want to become portfolio managers often have a 15+ year track record at the company before they get that opportunity. So if you're still with me, you're probably wondering what fund I've been talking about this whole time. It's American Fund's EuroPacific Growth Fund, a broad international stock fund. All right, so get this. If you'd invested in this fund instead of the Vanguard Total International Stock Market Fund when it came out in 1996, you'd have almost twice as much money today. That's after fees, using the highest expense ratio share class I mentioned earlier, which you can find in any brokerage account under the ticker AEGFX. Again, I have no incentive for you to buy this fund. You could buy this fund with $2 million and I want to make a penny. But I hope this has been a clear example of why it does make sense to consider active managers if you can find a quality one. So notice how short-term past results was not on the list. The things that are predictive of future results are low fees, multiple tenured portfolio managers, preferably who invest their own money in the fund, which you can find in the prospectus, a big team of analysts and portfolio managers, and they should be based all around the world if it's a global or international fund, a flexible approach, which you can find by looking at their descriptions of how they're managed and seeing how restrictive they are, a long-term approach, which you can find by looking for funds with a turnover ratio in the 30s or below, and ideally, multiple portfolio managers and analysts who also invest. The only fund families that I know have most or all these things are American funds, Prime Cap, MFS, Wellington, and some Fidelity funds. But there are probably some others out there too. So what do you think? Is it impossible to find a fund that could beat its benchmark over 30 years? Let me know in the comments below.